Let's face it, folks. The S&P 500 is like the hottest stock in town. Everyone's talking about it. Everyone's buying it. It's the buzzword on everyone's lips, from Wall Street to Main Street. The excitement is palpable, and the enthusiasm is contagious. But here's the thing. Just because everyone's doing it doesn't mean it's right. Just because it's popular doesn't mean it's the best choice for you. It's easy to get swept up in the hype, but we need to stay grounded. We've seen this before, haven't we? Remember the dot-com boom? Everyone piled into tech stocks. It was a frenzy, a feeding frenzy of investment. People thought the good times would never end. Then bam, the bubble burst. The market crashed and many were left holding the bag. It was a harsh lesson in the dangers of following the crowd without doing your homework. We don't want to see history repeat itself, do we? We need to be cautious and informed. We need to learn from the past to protect our future. The S&P 500 is an index fund. It tracks 500 of the largest US companies. It's a broad market index, representing a diverse range of industries and sectors. Sounds great, right? Well, not so fast. There's more to consider than just the surface appeal. We need to dig deeper. There's more to this story. It's time to take a closer look at the S&P 500. We need to understand the underlying factors and the potential pitfalls. We need to understand the risks involved. Every investment carries risk, and the S&P 500 is no exception. It's crucial to be aware of these risks before jumping in. Don't worry, I'm here to guide you through it. Together, we'll navigate the complexities and make informed decisions. Let's take this journey step by step.
Here's the deal. The S&P 500 is heavily concentrated in a handful of mega-cap stocks. Think Apple, Amazon, Microsoft. These giants are doing great, no doubt. But what happens if one of them stumbles? Imagine a scenario where Apple's sales plummet, or Amazon faces regulatory hurdles. The entire S&P 500 could take a nosedive. That's not a risk you want to take with your hard-earned money. Diversification is key, people. Don't put all your eggs in one basket, especially when that basket is overly reliant on a few mega-cap companies. Remember, even the mightiest giants can fall. It's time to spread your risk and explore other investment avenues.
Let's talk valuations. Some of these mega-cap stocks in the S&P 500 are trading at sky-high prices. Are they really worth that much? Or are we looking at a bubble ready to pop? Look, I'm a big believer in growth, but even growth has its limits. When stock prices far exceed a company's earnings potential, it's a red flag. We need to be cautious, folks. Don't get caught up in the hype. Ask yourself, are these valuations justified? Or are we being swept away by market euphoria? Remember the dot-com bubble? Don't let history repeat itself. Be smart, be cautious, and don't overpay for growth.
Here's another thing that keeps me up at night. The S&P 500 is heavily skewed towards the tech sector. Now, I love technology as much as the next guy, but too much of a good thing can be bad. When one sector dominates an index, it creates an imbalance. What happens if the tech sector takes a hit? The entire S&P 500 could suffer. We need to diversify across sectors, people. Healthcare, energy, consumer goods. There are plenty of other sectors with growth potential. Don't put all your eggs in the tech basket. Spread your bets and reduce your risk. Remember, a balanced portfolio is a healthy portfolio.
Section 5. Past performance is not a guarantee. Why the S&P 500's winning streak might end. Listen up, folks. We've all heard the saying, past performance is not indicative of future results. Well, guess what? It's true. Just because the S&P 500 has performed well in the past doesn't mean it will continue to do so. The market is cyclical. What goes up must come down. We need to be realistic about future expectations. Don't assume that past returns are guaranteed. The market can change on a dime. Remember, investing is a marathon, not a sprint. Don't chase past performance. Focus on building a diversified portfolio that can weather any storm.
Section 6. Diversification is your safety net. Explore these alternative funds. All right, folks, enough with the doom and gloom. Let's talk solutions. The good news is there are plenty of alternative funds out there that offer broader diversification. Think about it. Small cap funds, international funds, bond funds. The possibilities are endless. These funds can help you reduce your reliance on the S&P 500 and spread your risk. Don't be afraid to explore your options. Talk to a financial advisor, do your research, and find funds that align with your investment goals and risk tolerance. Remember, diversification is your safety net.
Section 7. Don't put all your eggs in one basket. The importance of diversification. Let's cut to the chase. Diversification is not just a fancy financial term, it's the cornerstone of sound investing. Diversification means spreading your investments across various assets. It's about protecting your hard-earned money from the unexpected. By not putting all your money in one place, you reduce the risk of losing everything. Think of it like this. Would you put all your eggs in one basket? Diversification is like having multiple baskets. Of course not. What if you drop the basket? You lose everything. But if you have multiple baskets, dropping one won't be as disastrous. The same principle applies to investing. Diversifying means you don't rely on a single investment. By diversifying your portfolio, you're spreading your risk. This means investing in different sectors, industries, and asset types. If one investment goes south, you have others to cushion the blow. This balance helps in maintaining stability. Remember, diversification is your best defense against market volatility. It helps in smoothing out the highs and lows. It's the key to achieving your long-term financial goals. A well-diversified portfolio can weather market storms and grow steadily over time. Section 8. Take action now. Secure your financial future with a diversified portfolio. We've covered a lot of ground today, folks. From understanding the basics of investing to diving deep into the nuances of market trends. We've talked about the risks of relying solely on the S&P 500. It's crucial to recognize that putting all your eggs in one basket can be risky. We've discussed the importance of diversification. By spreading your investments across various asset classes, you can mitigate risks and enhance potential returns. Now, it's time to take action. Don't just sit back and hope for the best. Don't wait for the market to turn against you. Proactive steps today can safeguard your future. Don't wait for the bubble to burst. Market volatility is inevitable, but your preparedness can make all the difference. Take control of your financial future today. Review your portfolio. Assess your risk tolerance. Explore alternative investment options, and most importantly, diversify. Consider stocks, bonds, real estate, and even commodities. Remember, the best time to plant a tree was 20 years ago. This timeless wisdom applies to investing as well. The second best time is today. Don't let another day pass without taking steps towards securing your financial future. So what are you waiting for? The journey to financial security starts with a single step. Start building your diversified portfolio today. Embrace the power of diversification and watch your financial future flourish.